Hello there, Adam Gower here, and welcome to the GowerCrowd Podcast, the real estate crowdfunding show Deal Time, where you can learn about active crowdfunded real estate deals directly from the sponsors themselves. Subscribe to my free weekly newsletter at GowerCrowd.com, where you'll get links to the podcast, as well as news and updates exclusively from the world of real estate crowdfunding. Sign up at GowerCrowd.com so you don't miss out. Also, if you want to pitch your deal on the show, just go to the podcast page at GowerCrowd.com and look for links on how to submit your deal. Please note that while I don't endorse the deal, sell securities, or make investment recommendations of any kind, some sponsors are GowerCrowd clients. Now listen in and learn about the next great deal on the GowerCrowd Deal Time podcast. Here we go. Mark, David, very happy to meet you. Chase Partners Limited. Thank you so much for showing up on my podcast. Why don't you give me an introduction? Who are you? What's your name, position, and name and position at Chase Partners? And then we'll roll.
Mark Panatoni, Managing Director here at Chase Partners. I'm in charge of all things for our fund that we launched this year. And I'm sitting here with David Parker, the president of the company.
Nice to meet you both. All right, so what have you got? Tell me about the fund, high level, basic parameters.
Sure. This year we launched a $100 million fund to purchase existing industrial property in Southern California. We love this market. It's growing. It's fast paced. The e-commerce numbers and the port numbers are through the roof, and we're seeing this market really grow. And so we're really excited to bring on some new partners with us and raise some money and buy some really great assets here in Southern California.
What is the term of the fund, Mark?
Sure. It's a 7-year term with a couple 1-year extensions based on market conditions, just in case we need it to liquidate.
And what's your capital call period? During what period of time are you raising capital?
Okay, we have a 18-month raise with 2 6-month extensions for the raise period.
All right, now tell me.
It started last month.
Very nice. Oh, perfect timing. Excellent. Right at the beginning, we can do this monthly with updates.
That's right.
All right, fine. So now tell me, industrial real estate. Hey, that is the flavor of the month, isn't it? Absolutely, no doubts about it. Tell me something about the kind of assets that you're looking for that are going to go into the fund and your underwriting standards.
So industrial real estate isn't new to us. We've been doing it for 40 years. Panatoni has been doing it for nearly as many years. And it's not our flavor of the month, it's our flavor of our life. And it's what we do. It's what we've been doing for a long time. It's Southern California, state of California. We can go in the whole state, but Southern California is our specialties. We've been doing it a long time. We've been around. We know it. We owned a lot of it. We built 300, 400, 500 buildings. This is what we do. Flavor of the month, though. It's the reason we put the fund together is there's just a lot of opportunity. It's really, really, really hard to replace industrial buildings right now with environmental conditions, financial conditions. It's a difficult process. Many cities are putting moratoriums on additional development of industrial buildings due to the trucking requirements and air pollution requirements and those standards. So we just think there's a great niche right now to buy existing buildings that need a little bit of love and care because it's a little specialized, the industrial business, and we're just finding tremendous opportunities in the range in which we're buying, which is $8 to $15, $20 million size buildings. It's a great market.
Yeah, and it was completely the wrong term to say flavor of the month. I didn't mean that. You are definitely riding a wave. If you've been in it for 40 years, you've been in the right industry for 40 years. Now is the time. There's no doubt about it. COVID has accelerated all the online trends. So forgive me for saying flavor of the month. That's not what I meant. But it is a very high demand asset class. It's a very high demand for investors. And it is little understood. So don't assume that anybody that's listening understands anything at all about industrial real estate, especially to the degree that you do. So just drill down a little bit for me, will you, on the kind of asset that you are investing? Because you have a very specific focus, don't you? So tell me about that $8 million sweet spot and exactly what kind of assets are they? Describe one to me. It's kind of the ideal purchase for you. What does it look like?
That's funny. The industrial building is a building. I always tell people when they say, "What do you do?" I go, I buy and sell and build buildings that you never even pay us. You never even give a second look to. These are all the buildings where commerce is completed, where industry manufactures and distributes their products, and where a lot of people spend a lot of their lives being employed and just working. These are typically off the beaten path type buildings, large warehouses. And the driver, as you said, which is tremendous, is, Amazon's building millions and millions and millions of square feet of distribution. If you service Amazon, you need to be close to them so you can get your product to them at the least cost and in a rapid fashion. And as Mark mentioned, being near the ports of Los Angeles, so much product, a third of the product in the country and 75% of the product in the West Coast comes through the ports of Los Angeles. And that product needs to be distributed from the port to a warehouse almost immediately. It can't sit in the port. So those warehouses are in high demand, and they're being built all throughout Southern California. And they have been for years, but it just was not, wasn't real well noted because e-commerce wasn't nearly as big as it is now. But the demand's never been better. Through the years, we've used industrial buildings for ice cream plants for Baskin Robbins, for we've done the movie studios for Warner Brothers and Disney, and just all the back end warehousing that they need and manufacturing facilities. And the demand now is just staggering. It's in Southern California, it's just staggering.
So that's a really interesting nuance that you've brought up. So am I correct in understanding that your target market is within the Amazon hinterland? Does that represent for you I want to say a credit tenant? We can talk about the tenant credibility as well a little bit. But if you're looking at suppliers to Amazon, I've never thought of that because it's $8 million. You're not buying an Amazon occupied 2 million square foot warehouse. You're talking about something different, aren't you?
Right. Yeah, we're buying the buildings that supply the Amazon warehouses
and others
and others.
Yeah.
The distribution side makes a good portion of it, but there's also some light manufacturing that goes in that gets distributed a little bit differently. But we are a supply chain to your Amazon. There's no doubt about it.
And so how do you guys assess tenant credit? How do you decide because if you get a vacancy, I know that the demand is very, very high, but it can take time. And it is, if you've got one warehouse and a tenant vacates, that's a whole warehouse. So how do you guys assess tenant credit?
When an $8 million building, you're going to have a regional credit. You're not going to get a major credit. It's going to be a local manufacturer, a local distributor, a contractor possibly. But one of the beauties of what our business plan is we not only have the ability to rent our buildings, but if the building does go vacant, Doctor, we can also sell the building to an owner user or someone in that category that needs a building for their own business, which is a huge demand as well. And so we have two options to exit our buildings in the event that they do become vacant. So that's one of the things we really like.
Right. And of course, owner operator is always going to pay more than a fund, for example. So it's always a good option for you to exit. So that does suggest, though, also, and on your website, I noticed these pictures of ground up development. So within the fund, are you considering ground up development or are you looking at value add?
Sure. It's mostly value add. We will not be doing any new construction in the fund that we're developing. But for instance, we do have a building in contract that's scheduled to be completed here in the next 6-8 weeks, where the developer got into a little bit of an issue and needed some cash to complete the project. And we found it was a great way to strike and get new construction in a market we want to be in.
Interesting. So that's like an opportunistic deal, which in industrial real estate sounds like you found the only one, basically, anywhere in the country. So kudos to you guys for doing that. So in terms of value add, everybody understands multifamily. You put in some cabinets and a new floor and you paint the walls and somebody pays you more rent. How do you add value to an industrial building?
I would say most of the stuff we're looking at has older leases in place, older tenants. They've been in there for the last one that we bought. They were there 25 years. They had let a lot of the maintenance go, the landscape, the parking lot, the roof, mechanical units, air conditioning. So it's just like an apartment, but it's on a bigger scale. So we're just going to go in and put paint and carpet in and clean them up, make them a little more accessible. Sometimes we have to add a dock high loading. That's really important to a lot of tenants. We'll upgrade the utilities, add more electrical power, add solar panels, and make the building more user-friendly and make it more available so somebody can come in and turnkey and start their business right away. They don't have to spend months and months remodeling the building, much like buying a home that's old and tired and beat up, or an apartment, same thing. We're just cleaning them up, making them more attractive, and changing the access and the physical nature of the building is really difficult. So we just have to do a lot of cosmetic appeal.
Yeah, and if I could just add one thing to that, in addition to your traditional value add, you also have the value add of your new leases, right? And structuring your new leases, and a couple of things that have come out, and the reports that some of your big houses like CBRE is putting out, they're expecting rent growth in the next couple of years to be about 40% by 2024 in the industrial market in LA, and over 30% in your Inland Empire and areas. And so that leaves us in a position where we may be paying a little bit lower cap rate, but in 18 months when that tenant rolls,
right,
we're bringing them up to market and really getting a bang for our buck.
So let's talk about that. Tenant leases and lengths of leases. With an apartment building, you start with 1 year and then typically shift to 1 month. And the only reason I'm keying off apartments is because most high net worth investors, accredited investors, it's what they understand. It's intuitive. As you've said, industrial real estate is usually hidden behind the retail. It's hidden away. People don't see it. There's no intuitive understanding. So help me understand how, if you buy a building, a value add building that has a tenant in it that's been there for 20 years, what are you doing? Are you saying we're not renewing your lease? Are you saying we're going to do some upgrades and increase your rates? Explain to me the mechanism of how you turn tenants, how do tenants turn, and how do you increase rental income over time?
Go ahead. I mean, typically we'll just go in and mark the building to market. We'll bring a brokerage firm in. We'll do an assessment of the valuation of the building. If it were on the market, we'll value what it will take to remodel and rehab the building. If we do go vacant, what the cost will be to pay commissions and downtime. And we'll offset against our IRR to see what a lease rate would be that would offset that and maybe be more profitable. Most of the time we can negotiate an extension with the existing tenant. They know they've been getting a deal for a long, long time. And they understand that, their product's in higher demand than it was when they leased it 25 years ago. And so it's a market-driven concept, but it's very similar, to what you're saying with apartments. It's just on a larger scale. And the beauty of industrial, again, is we can sell the building to that user. If there's SBA loans out there, they're very easy to get. And we can sell that building to him. I don't have that option in an apartment to sell it to my tenant. I don't have that option in a retail building to sell it to the tenant. Mm-hmm. I have two exit strategies here, and both are excellent.
Yeah, it's interesting you say that, because it begs the question, of course, that why would somebody sell the building to you if they could sell it to their tenant?
Again, sorry, we keep stepping on each other here. But again, a lot of times if the tenant does vacate is when we sell it. If that tenant typically will not be our buyer. It'll typically be the tenant will simply negotiate a lease extension. A buyer comes to fruition when the building's available for occupancy.
Got it. Tell me a little bit more then about, you've mentioned the geography, the range that you that you're looking at? Just kind of drill down on that a little bit more for me, will you? What is the full area that you're looking at? Just Southern California?
Yeah, just Southern California. We do have Ventura counties and San Diego counties identified. We doubt we're going to do much business in those. They're kind of their own marketplaces. We're really looking at the arteries coming out from the ports and which way they're going, whether they're heading up to Northern California, across to your Colorado and Vegas areas, or over to Phoenix and into Texas. And so you kind of have three different choices in which way you're going to ship out from the LA ports. And those along those artery lines is really where we're looking.
Let's talk about from the investor perspective for a few minutes. So somebody comes in, your minimum's 100,000 or 250. What is it? 250, right? 250,000 minimum. What is the talk to me about the numbers? What's the cap rate? What are your projected returns, distribution frequency, etc.?
Sure. We have a 6% pref that we're doing, 80-20 split with the investor, up to a 10% IRR, and then 70-30 thereafter. We're projected between an 8 and 12% IRR to the investors. We expect we'll be able to pay in the first year 4% current, with that growing annually as the leases grow in turn. But starting at 4 and then growing and catching up to that 6 pref.
All right, so let's talk about that, because this is a fascinating asset class. And a 6% pref is below market for accredited investors. When they go online now, they can find typically actually 60% to 8%, 20% to 10%. So you're in a rarefied area. How do you answer investor questions when they say, hey, look, I can get an 8 pref in this multi-family building over here, or this office building, for example? Why should I invest with you and only get a 6?
Well, again, that's our pref. We're looking at IRR as we've conservatively put them in at 8 to 12%. On most of our products that we've done through the years, we're 17, 18, 19%. So we're buying good stuff. We're buying right stuff, well located, well built, hard to replace. And it's slow and steady. We're not trying for the high churn, high burn type product. We're not trying to just burn and generate fees here and there. We're trying to put assets away. This originally started when a few of my longtime investors and relatives said, I want to put money in industrial properties, but they didn't want the risk of development, which is what we've done a lot of. And I said, well, we don't really buy and hold buildings. And that's when Mark and I met up. And Mark said, I love buying and holding buildings. So with the knowledge that we both have, and with the ability to generate a lot of returns for our investors, is where we started this. We just wanted to be realistic and not go out blurting an 8 to 10% pref and all this. We want to make sure that we can meet our requirements. And these leases, they don't turn fast. And since we only get one opportunity to turn them, if I buy an undervalued building right now, I can't promise a huge return until we do turn the lease. So again, I think we're very realistic, maybe too realistic, but we didn't want to come out there and just promise the moon and not be able to deliver.
But also the other thing is that industrial has tremendous stability as well. Of course, you do suffer vacancies from time to time, and they can take time to fill, but you do have stability. It's a coupon clip, right? And typically, I presume that your investments are a triple net, your leases are triple net.
Correct.
Right. So you're really just managing, right? There's not much to give. You're just taking rent payments.
Well, it's not that easy, or everybody doing it.
I know that. All right. So hang on. This is an interesting point, though. This I find very interesting. So buy and hold. You want to hold. By the way, we are doing 15 minutes, but if you don't mind going longer, this is a fascinating topic. I don't know how much further I can go, but are you guys okay continuing?
Great.
All right, good. Let's keep going. So the idea that you would want to buy and hold, right? I mean, you guys have got hundreds of years of experience. It says 50 years of experience, but I imagine between you've got hundreds of years of experience in this field. So you know, and you wish that those buildings that you sold 20 years ago, you'd held on to. So why have you decided to put a fund together that has a defined lifespan that you have to exit from? Tell me about that.
Well, that was really based on feedback we got from different advisors. We'd love to put something together where we would bought it and never let go. I think that's probably more of a REIT structure. But this being our first fund, we thought that it was the right vehicle to kick off with.
Okay, perfect. All right. So now you talked about fees. Everybody wants to know, where's the alignment of interest? So tell me, what are the sponsor fees from acquisition to AUM to exit? Just give me the full gamut.
Sure. We have a 1% acquisition fee, 2% assets under management fee, and a 1% disposition fee. We do the property management, and we're able to charge up to 3%, whatever is market. We don't look at that as a profit generator by any means, but more of a cost control. And so we're doing market rates and whatever our costs. So we can charge up to 3% of gross rents on that. That's pretty much it on the fees.
The big money is in the profit. When the fund throws off money, we don't make any money until the pref is paid, and then we split it and we take, like Mark said before, we're going to take 20% of anything after you hit a 10, we take 30%.
Right. Actually, but just to be sure I understand that right, you don't take anything until the pref is paid and the principal is paid back, correct?
Right.
No catch-ups. You just go straight to
catch-ups on our side. No.
Okay. And what's your co-invest?
We're putting in between 8 and 10%.
So 8 to 10 million.
Yeah.
And that comes from the management team?
That's correct.
That's you guys. So for anybody that invests in the fund, $250,000, is there any possibility of an early exit? I'm just curious if there are any provisions in your fund docs that allow for the sale of ownership shares.
The sale of ownership.
So somebody invests, and then somebody passes away, and somebody unforeseen. So it's technical more than anything. But is there any way out? It's okay if there isn't. Most funds don't have.
There is. We would work with whatever situation came across. These shares are typically non-transferable. I mean, your heirs can receive them. But if a party came to us, we'd do whatever we could to
figure something out.
Yeah.
What's the fund's leverage policy? Because I know that's a big deal.
Sure. It's a max of 6%, 60% on the fund and 65% on any individual asset. And that's because if we do have to do some value add, we want the flexibility to just to put a little bit of extra money into a building. But from a total fund perspective, it's at 60%.
And tell me,
we're still borrowing at 3%. So I mean, if we can buy a 4 to 5 cap, we're still positively leveraged, even if we take 60% loan. So we did want that amount. The original target was to be no more than 50%, but just with the interest rates the way they are, we just thought we'd give ourselves a little edge to go to 60 or 65 if we had to.
And that's so 60 is the fund level, but you could go higher on individual.
Right.
So if you got a 65,
65, yeah.
All right. And just tell me so in 7 years' time, I invest $250,000 today. In 7 years' time, what is the exit strategy? And what is the downside? What exit strategies do you have? Is my question.
There's a couple of them. The first is you'd go through and you sell off every asset over a course of a few years as the rents mature and you're at the max value, and you liquidate over time. The other would be to sell the entire portfolio to another group.
Okay, so now let's talk a little about your background. So we know that you have hundreds, thousands of years of experience. Just kind of give me a quick.
You heard me.
I did. Give me. I like to tell people that I go back to the pyramids. I was a laborer.
I bet it was hard to get your computer to work then.
All right, so just give me a quick rundown. What is your background? Because I noticed you actually on the pitch deck that you sent me, I think it says a lot of experience in real estate. Specifically, it says real estate. It doesn't say industrial real estate. So tell me more about your background a little bit. Give me some color.
Go ahead.
Okay. Well, I've been in the real estate game since my I guess it'd be mid-20s or so. I had a law degree, worked in a law firm that did exclusively real estate transactions. Then we opened a securities company to process investors for those same real estate deals that we were doing, and went through all the underwriting there. Then we started buying our own assets. Did a lot of multifamily. We did a lot of industrial, and then that leads us to today. And partnering with Dave, who has a lot more vertical development experience than I do. Mine's more on the underwriting and management side.
So I'll tell you what, do me a favor, give me some client numbers, square footage, in terms of number of square feet of industrial space or dollar volume or dollar value over the course of your career. Just give me kind of some high level numbers. What does it look like?
Oh, geez, I wouldn't even know where to start.
I mean, the Panattoni name is a legend in the industrial real estate business. I mean, Mark's been involved in it for years. I ran the Charles Dunn Company. I worked at the Charles Dunn Company downtown Los Angeles. They've been around about 100 years, almost back to the pyramids. And I was in the investment division there and ran Chase Partners through there initially. So in the 40 years, I started out in apartments. I know them well. I started out building them and renovating them. Did that for a long time, but housing just got very, very difficult to build in Los Angeles, and it's gotten more so now. And so then we moved on and started doing build-to-suits for County Los Angeles and larger tenants. And then, but really the industrial was where we've been focused for the past 30 plus years. Industrial's easy. I like it. It's just, we did about 1 million square feet last couple of years. We probably done in transaction number. We built 300 to 400 buildings, maybe more, individual buildings. We have done at least, I got to say, $1 billion worth of real estate in my career, doing larger projects and projects that we've been involved in that period. So we just have been involved in it day to day for a long time. Largest building we've ever built is kind of, above the sweet spot, probably 250, 300,000 feet on the large side. But again, our sweet spot's 8 to 10, $15 million. The 30 to 40,000 foot buildings, those buildings kind of fall below the radar of the REITs, the stock exchange traded companies, but they're above the level that a small guy or a contractor can really build just on spec for his own account. So we're kind of fitting a good niche there. It does take a little more money, which is one of the reasons we started the fund. And it's a good opportunity to really be involved in a market that's not getting as picked over as some of the other markets. And that's really where our experience has been all these years. And as far as transactions, been involved in over 1,000 transactions, sale and lease. Again, at the Charles Dunn Company, 25 years. Chase Partners was 15 years of that. We started Chase Partners in 93, actually. And, it's just what we've done for a long time. It's what we do.
I've got 2 more questions for you, but one more question, but I'm going to introduce another one. And that is, when I started with crowdfunding 6 years ago, it occurred to me that there were some superstars of the industry. That if you're in the industry, that's right. If you're in the industry, you know everybody. But the accredited investor community, the non-real estate investor, the high net worth individual, has no clue, because it's essentially historically, it's been a closed industry. And you said something a moment ago, David, that Panattoni, forgive my pronunciation, is a legend in the industry. That is not a trivial thing to say. So for somebody like me who doesn't know, and the one other guy who's listening now that doesn't know who the Panattoni family is, in industrial real estate. Please tell me, what does it mean to be a legend in this industry?
He's shy, but it's not. Go ahead.
Yeah, Pantone Development's been very successful. It's my uncle's company. I've worked around the company for several years of my career, but they've done a very, very nice job building a great company.
Over how long? Let me just tell you something. My job is to help people find investors.
Mhm.
Don't be bashful about things that really mean something, because what you're talking about is deep, multi-generational knowledge and expertise. And investors, they don't invest in industrial real estate.
Mhm.
They are investing with you. That's who they're investing with. And so they need to know who you are. And it's okay. This is a short podcast call. That's okay. But going forwards, I would strongly recommend finding confidence in discovering a way to be able to articulate that way that is impressive. Even if it is humble, that's fine. But it's very, very important. People want to know who you are.
Sure.
Last question. Investor avatar, the ideal investor. If there was one person that was listening to this podcast today, what would you, the absolutely perfect candidate for your fund, he's going to write you a $10 million check, and he didn't listen to anything but this last sentence or two, what would you want him to hear?
What would we want him to hear?
Well, yeah.
This is, I would say, this is an opportunity to place funds into Southern California real estate, led by a group of experts who've done it for thousands of years, as you said, thousands of years of experience, but really with 60, 70 years of experience, well-known in the industry, and straight shooters. They're doing it for family and friends. We're not doing it to start the fund. We're doing it for family and friends, and that's what really got this going. So it's a good opportunity. We've done a lot of partnerships through the years, but this is a great opportunity for outsiders to get involved.
And I'd just add, this is one prong in someone's investing strategy.
Mhm.
We looked at this and wanted to do something a little bit more conservative than your typical high teen, I'm in a real estate development project. We wanted to provide a different vehicle and show people the security of the asset that we're buying.
Beautiful. Diversification within real estate.
Yeah.
And the fund does that too by buying several buildings. So you're not subject to one guy canceling and another company canceling, or, a larger company, bailing on one building, because we'll have a multitude of buildings. So it's going to be across the full asset class of property in the region. And that was more why we want to put the fund together too, with smaller buildings grouped together in a larger pool.
Mark Pantone, David Parker, Chase Partners Limited, an enormous pleasure meeting you. Thanks so much, truly, for being on the podcast today.
Adam, thanks a bunch. Appreciate your time today. This was great.
Yeah, thanks. It was fun.
If you want more information on this deal and on all the others in this new series, plus if you want access to the latest news from the real estate crowdfunding industry, and if you want to be the first to know about some amazing proprietary industry data that we're putting together for you, subscribe now to the GowerCrowd newsletter at GowerCrowd.com. It's totally free, and it is the most comprehensive source of news and information about real estate crowdfunding anywhere on the planet, all there at GowerCrowd.com. Thank you for joining me and for listening in to today's deal. This is Adam Gower wishing you well and signing off.